Welcome to TaxLawGH and welcome to the continuation of our session on employment income or income from employment. If you watch part 1, which I highly recommend you watch before watching this, you would remember that we said employers are required to withhold tax when they are making payment to employees on a monthly basis. How does the law recommend this is done? To be honest, because this video is exam focused, so for law students, for students of ICA, CIT, Masters or Bachelors program in tax, this concept is not properly examined. What do I mean? What you need to know is that the law prescribes or mandates an employer to withhold tax when making payments to an employee. This formula you see on the screen is not something you must know per se. It's just a nice to know. It's in the Income Tax Regulations, Regulation 4 of the LI 2244. What it says is, subject to the rules of taxation of overtime and bonus payments, which we'll look at subsequently very soon, when an employer makes a qualifying cash payment to an employee during a year, the employer is required to withhold tax. We've already established that. We're saying the employer is required to calculate the amount of tax to be withheld by applying the following formula: A times B over C, where A is the amount of payments the employer is making to you, B is the employment tax liability of the employee for the whole year, estimated under sub-regulation 3, which we've looked at previously before in the last part of the video before this one. So whatever the employment tax liability for the year is, take that, then you deduct or less tax withheld under this tax this sub-regulation, what we are looking at now, by the employer from previous qualifying cash payments made by the employee during the year of assessment. So it's essentially, the B part is the employment tax liability of the employee for the whole year, less any taxes already withheld, right? And then the C is the total of the payments referred to in A, which is the amount of the payments, right? And then any qualifying cash payments still to be made by the employer to the employee. So essentially, A is how much the employer is paying the employee. B is the tax liability of the employee for the year, right? Less any tax the employer has already withheld and paid off to the GRA. And the C part is saying that is the total of the A figure and then any remaining payments the employer is yet to make to the employee during the year. What does this mean for you? I'm saying for the purpose of calculating this using this formula, the employer may, at the time of making the payment, make a reasonable estimate of a number of things. We say this because if we are being really technical, what the law provides us with is an annual income tax rate for resident individuals. So the table I showed you at the beginning of part 1 of employment income, you remember that we had a number of bands with the first figure at 0, the next amount at all the way to 30% for amounts exceeding 240,000. What we are saying is, what the law provides is annual. To be honest, there's no monthly rate anywhere. What we have done over a period of time is to divide the annual rate by 12 and then use the monthly rates to find how much to withhold on a monthly basis by the employer, right? So we're saying the employer is required to make a reasonable estimate of the tax liability of the employee in the month, right, when they are making payments, and then they are required to make this or withhold this amount and pay off to the GRA, essentially, right? All this slide is saying, don't bother your head too much about it, is that employers are required to withhold an amount when making payments on an employee. There is a certain formula that needs to be used, and I've explained that. For exam purposes, the modalities here do not really matter, but you can pause and take a read. If you have any question on this, feel free, leave a comment in the comment section below, and then I'll jump in there and respond. So still here, an employee may write to the Commissioner General for an adjustment of any amount that has been withheld where the qualifying payments include an amount that doesn't have a source in Ghana. So let's say wrongly your employer withheld an amount and paid to GRA, where the amount didn't have a source in Ghana and then should not have been taxed here. You can write to the Commissioner General for an adjustment, right? Then when the Commissioner receives the application you send to him, he can adjust the amount that should have been properly withheld. So this will be done on an adjustment basis. So in subsequent periods, your employer may have to withhold less from you to make up for the difference, essentially, right? Let's look at what is also very common in exams. In every computational question on employment income, it's either overtime features or bonus features or both. I am yet to see an employment income computational question that doesn't have either or both of overtime and bonus. So please remember these rules. It will be in your exam, guaranteed, hands down. Overtime payment, we know what it means. It means when you work more hours than required, basically at the fundamental level, right? Overtime payment, we are saying where an employer makes a payment for overtime work to a qualifying junior employee. Take note of this term. You must be a qualifying junior employee before these rules apply to you. During the year of assessment, the employer shall withhold tax from the total of that payment at the rate of 5% if the amount paid does not, take note, does not exceed 50% of the basic salary of the employee for the month, or withhold tax from the excess of that payment at the rate of 10% if the amount paid exceeds 50% of the basic salary of the employee for the month. When we get to the point where we do computational questions, I'll show you how this is done. But let me explain this. What we are saying here is where an employer makes payments to an employee, first thing you need to check is the employee a qualifying junior employee? If they are not, forget about these rules. The whole amount is taxable as normal employment income, right? So this is for qualifying junior employees, which I'll define shortly. We are saying that for you to determine how much of overtime amount is to be taxed, if the person is a qualifying junior employee, first thing you need to do is pick the basic salary of the employee, compute 50% of that basic salary of the employee. Let that be your benchmark. Put that aside. Then compare the overtime amount paid to the employee to the 50% you computed. So let's say an employee's basic salary, for simplicity, is 100 cedis. 50% of 100 cedis is what? 50 cedis, right? And then we are saying if the overtime payment does not exceed 50% of the basic salary, you withhold 5%. So let's say the numbers I used, the basic salary is 100 cedis, 50% of 100 is 50 cedis. The employer pays the employee 20 cedis as overtime. You agree with me that 20 cedis does not exceed 50 cedis. So this overtime payment does not exceed 50% of the basic salary. In that case, the employer will withhold 5% tax on the overtime payment of 20 cedis. That's what the law is saying. So pick your basic salary, find 50% of it, compare the 50% threshold to the amount of overtime payment made, and then find out if the amount of overtime payment is up to 50%. If it's not, withhold 5% from the whole amount. That's scenario number one. Scenario number two is where we are saying the employer will withhold tax from the excess payment at the rate of 10% if the amount paid exceeds 50%. So we are saying here, let me give you the same numbers. So an employee still has a basic salary of 100 cedis. 50% of 100 cedis is 50 cedis. This time, instead of 20 cedis overtime, the employer paid the employee, let's say, 70 cedis as overtime. What the law is saying is that you withhold tax from the excess at 10%. So what it means is the first 50% will attract withholding tax at 5%. Then the extra will attract tax at 10%. Let me use numbers. Remember, basic is 100 cedis. Remember, 50% of 100 cedis is 50 cedis. So if the employer pays 70 cedis, the first 50 cedis of the 70 cedis will be taxed at 5%. Then the extra 20 cedis on top of the 50 to make it 70 will be taxed at 10%. Let me take that again. The first 50% will be taxed at 5%. Any excess payment above the 50% threshold will be taxed at 10%. Take note once again, this only applies if the payment is made to a qualifying junior employee, which I'll define very soon. We are saying where an employer makes a payment for overtime to an employee who is not a qualifying junior employee, the payment shall be included in calculating the income of that employee from employment and taxed in accordance with the fare schedule, which is the rate I showed you, the table. First amount at this, next at that, exceeding 30%, blah, blah, blah. So we are saying over here that if you're not a qualifying junior employee, we'll tax this over time as if it's a normal income you made from employment. You won't enjoy these special reduced rates. We are saying here that an employee, this is a definition of qualifying junior employee, is a qualifying junior employee for a year of assessment if that person is a junior staff member, number one. Number two, and that person's qualifying employment income for the year does not exceed 18,000 Ghana cedis. So when we take the person's qualifying employment income for the whole year, it does not exceed 18,000 Ghana cedis. And in addition to that, the person is a junior staff member, then that person is a qualifying junior employee, and the special rate above 5%, 10% will apply to them. If your qualifying employment income exceeds 18,000 cedis, you are not a qualifying junior employee. If you are a senior staff member, but your income does not exceed, you are still not a qualifying junior employee. So it's two conditions that must be satisfied. You must be a junior staff member, and also your qualifying employment income must not exceed 18,000 Ghana cedis for the whole year. We've looked at overtime. Let's look at bonus payments. Obviously, bonus is a common payment in the world of employment. Different employers pay different employees different bonuses for different levels of performance. So if you do well in your job, you'll be paid a performance bonus, and different levels of bonuses. There are all types of weird bonuses out there. We are saying that where an employer pays a bonus to an employee during a year of assessment, the employer is required to withhold tax in a certain way. Different rules from overtime, right? If the total of the bonus payments made by that employer to the employee during the year of assessment does not exceed 15% of the annual basic salary of the employee, the employer is required to withhold tax from the gross amount of the payment at 5%. Or if the total bonus payment made by the employer to the employee exceeds 15% of the annual basic salary of the employee, then the employer will add, take note, it's the excess payment to the employment income of the employee, and then withhold tax in accordance with the rate in the fare schedule. That's the table I showed you for employment income, the stratified or the layered one. First amount is nil, next at that. That's what we're seeing here. So let me break this down. Where an employer pays bonus to an employee, the first step you need to work on is computing 15% of, take note, it's not monthly basic, it's annual basic salary. Over time, we were comparing it to what? A monthly figure, remember, right? But bonus is on an annual basis. So it's saying, let me show you the overtime. So you can see it's saying overtime, look at the first bullet point, does not exceed 50% of the basic salary of the employee for the month. Overtime is monthly, bonus is annual, right? So if the amount does not exceed 15% of the annual basic salary of the employee, then you withhold tax from the whole figure, the whole bonus amount at 5%. So let's use numbers. You are an employee. Your total basic salary for the whole year, annual basic salary, is 100 cedis for simplicity's sake, right? And then your employer makes a bonus payment to you. Our threshold will be 15% of your annual basic salary. So in this simple example, 15% of 100 cedis will be 15 cedis, right? Okay, we are saying that if the bonus payment is made to you and the bonus payment does not exceed the 15% threshold, which is 15 cedis in our case, then the employer should withhold tax from the whole bonus amount at 5%. What this means is, with our 100 cedis annual basic salary and with our 15 Ghana cedi threshold, which corresponds to 15%, if the employer pays me 10 cedis as bonus for the whole year, what it means is that because the 10 cedis does not exceed my 15 cedis threshold, I'll withhold tax from the whole 10 cedis at 5%, and it ends there, end of story. Let's look at scenario number 2, similar to the bonus overtime case, where this time the payment made by the employer to the employee exceeds the 15% threshold. We are saying that if the total bonus payments made by the employer to the employee during the year exceeds 15% of the annual basic salary of that employee, then the excess payments will be added to the employee's income and tax accordingly. So with our same simplistic example, 100 Ghana cedi basic salary annual, 15% threshold, that is 15 cedis. This time around in scenario number 2, the employer doesn't pay 10 cedis as bonus. They pay 20 cedis as bonus to the employee. We compare to the threshold and we realize that actually 20 cedis exceeds our 15 cedis threshold. So the first 15 Ghana cedis is within the threshold. We withhold tax from that at 5%. Then the extra on top of, what number did I use? 20, right? Yeah, the extra on top of the 15 cedis, that's the extra 5 cedis. We'll add that whole 5 cedis to the person's taxable income for the year from employment, and then it will go through the stages. So the first amount at this 0%, the next at that, in that order. So remember, for bonus, always determine 15% of annual basic salary, then compare the amount paid to that 15% of annual basic salary. If it is less than 15%, withhold tax from that at 5%. If it is more, withhold tax from the 15% portion at 5%, and then add the excess to the employment income and tax it accordingly, right? Okay, so we are saying the person shall, in calculating tax on bonus, calculate the tax on the basic salary of the employee for the year of assessment to which the bonus relates. So it's about the year that the bonus is being paid, it's in reference to. So if we are paying you bonus for 2020, we'll use 2020 annual basic salary as a reference point. That's what the law is saying here. Let's look at very important concepts on finality of payment. I'm sure this is like the millionth time I'm mentioning something being a final tax if you've been following this video series. We are saying that tax withheld on bonus and overtime payments is a final tax, and the payment shall not be included in calculating income derived by the employee from the employment. Once we withhold it here, end of story. You don't owe any further amount with respect to the overtime and bonus payment. And the tax paid by withholding satisfies the tax liability of the employee with respect to the payment and may not be reduced by any tax credit allowed to the employee under the Income Tax Act. So just remember from here, takeaway point is that bonus payments are final. Oh yeah, what happened? Bonus payments are final. Overtime payments are final. The tax liability suffered on them. End of story. It ends there. Remember that. We've come this far. Let's take some concept checkers to see how well you have been following. So the first question, the required is saying, given the provision in the income tax laws on the provision of accommodation by an employer on the site of business of the employer, explain the tax treatment of the above accommodation benefit received by Suplex City employees. So question 1 here is saying that Suplex City Company Limited is a retail company in Ghana. It provides accommodation to its employees in company housing facilities on the topmost floor of the retail shops, which occupy the ground floor. Suplex City owns the whole 3-story building. So we are saying here that a company called Suplex City Company Limited has a 3-story building. The shops are on the ground floor. Then it houses its employees on the top floor. This is clearly an accommodation benefit received by the employees because they get free housing to live in company building. The requirement here is saying that given the provision in income tax laws that have to do with the provision of accommodation being exempt and all of those, explain the tax treatment of the above accommodation benefits. Please hit the pause button and let's see how well you do on this one. Let's see how well you do on this one. So you can hit pause and then try. Okay, so let me help you out. Remember, we said those who are exempt will be persons who have or who work with mining companies, building companies, timber, building, construction, farming, petroleum. I hope I didn't leave anything out here. So these main companies are the ones that enjoy the exemption. A retail company is not listed in the law as an employer that enjoys this benefit. So the answer will be Suplex City employees will be taxed on this employment benefit. How will they be taxed? We'll look at that in the next session. The next thing we'll look at will be quantification of benefits. So whether you get accommodation benefit, the company gives you free housing, free car, how do you tax those? We'll look at that subsequently. So what we are saying here is because Suplex City is a retail company and doesn't qualify under the mining, building, construction, timber, oil and gas, and all that, they will be taxed on this accommodation benefit. Question 2, explain the tax treatment of a tip of 150 Ghana cedis received by a waitress of Swanton Bomb restaurant from a customer who was impressed by the services of the waitress. If you listen to me carefully, in I think part 1 of this video, I said that a tip technically can be considered to be a gift received under an employment. And if you watched our first video, we said a gift received by an employee from an employment is technically part of the employment income of the person. So this waitress is required to include this 150 Ghana cedis as part of employment income and get it taxed accordingly. Final question, it's a true or false question. We're saying that an employee is a qualifying junior employee for a year of assessment if the employee is a senior staff member and the qualifying employment income of that employee from the employment for the year does not exceed 18,000 Ghana cedis. True or false? You can pause and let me know what you think. Obviously, the answer is false. Why? Who caught the trick? We said in the question here, in the question stem, that the employee is a senior staff member. Take note, what the law says is you must be a junior staff member and have your qualifying employment income not exceeding 18,000. Here, the person's employment income qualifying does not exceed 18, all right, but they are a senior staff member. So this is a wrong definition of who a qualifying junior employee is. So this brings us to the end of part 2 of employment income taxation. We'll continue in the next session. For now, don't forget to smash the like button if you love this and share this video within your network. I'll catch you shortly.